Hey, moneymakers, welcome back. You know that feeling when your investments are just kinda sitting there, like they're to be growing, but you're not seeing that sweet, sweet cash flow? Today, we're diving into a strategy that can solve that covered call ETFs. Think of it like renting out your stocks for monthly income. We're going to break down how these ETFs work, why they're blowing up right now, and most importantly, which ones actually fit your risk tolerance. Because yeah, a 12% yield sounds amazing, until you realize the share price can tank just as fast. We'll rank 6 of the hottest funds, reveal fresh 2025 yield projections based on current market data, and wrap it all up with a 45-second quiz to help you pick the ETF that belongs in your portfolio, not just some random YouTubers. All right, let's break this down. Imagine you own 100 shares of, say, Apple. You could sell something called a covered call option, which basically lets someone else call dibs on buying those shares from you at a specific price by a specific date. In exchange, they pay you a premium up front. It's like renting out your stocks. Now, a covered call ETF does this automatically across hundreds of stocks. They collect all those premiums and pass them on to you as dividends. Often paid out monthly. Pretty sweet, right? But hold on, there's a trade-off. If the stock price explodes higher than your strike price, you miss out on some of those gains because you agreed to sell at a lower price. That's why covered call ETFs are best for sideways or gently rising markets, not those crazy bull runs where everyone's making bank. But here's the thing. In a volatile market like we're seeing now, those steady premiums can be a lifesaver. Plus, with inflation still biting everyone in the butt, that extra cash flow can help offset rising costs. And listen to this. Right now, there are 38 different US ETFs using covered call strategies. That's over $65 billion under management, which is up 40% compared to last year. People are catching on to this strategy, and for good reason. Now, if you're thinking, Graham, just show me the ETFs with the juiciest yields, I hear you. But remember, high yield often means high risk. It's like that old saying, if it sounds too good to be true. 2 ETFs that fit this high risk, high reward category are TSLE and Coney. TSLE focuses on everyone's favorite tech darling, Tesla, while Coney invests in NASDAQ 100 companies and uses leverage to amplify those returns and the risks. Now we're talking potential yields upwards of 12%, even pushing 15%, depending on market conditions. But here's the catch. If Tesla or the NASDAQ take a nosedive, your investment is going down with it, and those juicy dividends might not make up for the losses. This is where your risk tolerance comes in. If you're someone who checks the markets every 5 seconds and freaks out over every dip, these high volatility ETFs are probably not for you. But if you're comfortable with a little more risk, if you're playing with fun money that you don't need for the next 5 years at least, and you believe in the long-term growth of these companies, then TSLE or Coney might be worth a closer look. Okay, so maybe those high volatility ETFs are a bit too spicy for you. You want something a little more stable? Well, that's where JEPI and Devo come in. JEPI, my friend, is like the LeBron James of covered call ETFs. It just crossed $40 billion in assets under management this past quarter, making it one of the most popular choices for investors looking for steady income without the roller coaster ride. Why is it so popular? JEPI invests in the S&P 500. Those are the biggest, baddest companies in America, and it only sells covered calls on a portion of its holdings. This means it can still participate in some of the market's upside while generating that sweet, sweet income. Then we have Devo. This ETF focuses on dividend-paying companies, think established businesses with a history of sharing profits with investors. And just like JEPI, Devo only sells covered calls on part of its portfolio, aiming for that balance between income and growth. Now, are you going to get those crazy double-digit yields like with TSLE or Coney? Probably not, but you are getting more stability, more peace of mind, and, let's be honest, a better night's sleep. Now, if you're the type of investor who likes simplicity, who wants broad market exposure with a side of income, then listen up. QYLD and XYLD are your new best friends. QYLD basically says, you know the NASDAQ 100, that index full of tech giants that everyone's obsessed with? Yeah, we're going to sell covered calls on that and give you the cash. It's like having a mini Nasdaq 100 in your portfolio that pays you monthly rent. XYLD does the same thing, but instead of the Nasdaq, it tracks the S&P 500, so you're getting exposure to the biggest companies in America while collecting those option premiums. The beauty of these ETFs is their simplicity. You don't have to pick and choose individual stocks. You don't have to worry about complicated options strategies. You just buy the ETF and let it do its thing. Of course, the trade-off is that your gains will be limited if the market takes off, but in a sideways or even slightly bearish market, those consistent dividends can make a huge difference. All right, let's make this real. Let's say you have 15 million Naira, that's about 10,000 US dollars, and you want to invest it in one of these covered call ETFs. Scenario A, you go all in on TSLI, chasing that double-digit yield. At a 12% annual yield, you're looking at roughly 500,000 Naira in monthly dividends. Not bad, right? But here's the catch. What if Tesla drops 30%? It's happened before, and it could happen again. Your 15 million Naira investment is suddenly down to 10.5 million. You just wiped out an entire year's worth of dividends. Scenario B, you play it a bit safer with JEPI. At a 7% yield, you're looking at around 90,000 Naira in monthly dividends. Now let's say the S&P 500 drops 30%, a major market correction. Historically speaking, JEPI might see a drawdown around 18%, leaving you with about 12.3 million. See the difference? Yield chasing can be tempting, but it's crucial to consider the downside. Okay, it's decision time. Which covered call ETF is right for you? Let's do a quick quiz. First question, do 20% or greater price swings in your investments keep you up at night? If you answered yes, stick to the conservative picks like JEPI or Devo. If you're cool with a little more volatility, the high income plays might be a fit. Next, do you already own a lot of tech stocks? If so, you might want to diversify and consider XYLD instead of QYLD. Don't put all your eggs in one basket, right? Finally, and this is a big one, are you relying on this investment for monthly income to pay bills? If so, prioritize ETFs with yields above 8%, but make sure you understand the risks involved. So, recap, income hungry and risk tolerant, Tisli or Coney could be your jam. Need that sleep well, core income. JEPI and Devo are like the reliable friends of the ETF world, and for broad market exposure with a side of cash flow, QYLD or XYLD might be the ticket. The key here, folks, is to match the ETF to your stress budget, not just your wallet, because at the end of the day, the best investment is the one you can actually stomach holding on to, especially when the market throws a tantrum. Smash that like button if you learned something new today, subscribe for more weekly cash flow tactics, and let me know in the comments which covered call ETF is earning a spot in your portfolio this month.